Big news at Spotify. Layoffs, a lot of them. And the third time that it's happened this year. This time, about 17% of their workforce, or around 1,500 people, cut. The message from the CEO: we have to become relentlessly resourceful.
Companies like Spotify, which have been consistently posting losses, cannot continue doing business like that. That's not sustainable.
Spotify is one of the biggest streaming platforms in the world. So why are they struggling? Spotify makes the bulk of its money, almost 87%, from monthly subscribers. And the number of paid users has skyrocketed from 18 million in 2015 to 226 million in 2023. What each subscriber pays has also gone up. An individual plan in Canada, for example, up $1 this year to $10.99 a month. Multiplied across hundreds of millions of paying users worldwide, that's billions in revenue. But here's the thing. Spotify actually only keeps about 30% of that. Somewhere around 70% goes back to the rights holder, usually the record label.
It's an extremely difficult business to be profitable in.
For Spotify, those margins are pretty thin, and music's a little different than film or TV. When you think of other streaming giants like Netflix, they also make money through subscriber fees, right? But they also have original content.
All one wants is for that girl to find peace.
Netflix pays to produce its own original shows, like The Crown, and then has unlimited rights to that series. It's a great way to pull in subscribers because viewers can't get that content anywhere else. Spotify, on the other hand, doesn't have exclusive rights over the music it puts up for streaming. Most of it exists on all of its competitors' platforms too. So, the company made a big bet that hasn't really paid off. In 2019, Spotify went all in on podcasting. It spent hundreds of millions to acquire entire studios with dozens of shows.
The streaming giant out with a bullish forecast during the company's investor presentation, saying the more than $1 billion committed to podcasting will soon pay off, including gross margins.
They also signed exclusive deals with celebrities, paying millions to sign big names.
The Duke and Duchess of Sussex have joined forces with Spotify to produce and host podcasts.
Former President Barack Obama and former First Lady Michelle Obama will be producing exclusive podcasts covering a wide range of topics.
The hope was that these deals would snowball, lead to more subscribers, more success, but a lot of them struck out.
Even Barack Obama hasn't really, demonstrated the ability to attract and retain customers for Spotify.
Joe Rogan's podcast was at least one bright spot, but even that's not a total exclusive. You can still watch highlights of Rogan's show on his YouTube channel for free, and there's no guarantee he'll stick around. There are reports he may look beyond Spotify.
The great Joe Rogan's contract is up with Spotify and he holds all the cards.
That $200 million is a lot of money, but when you have 11 million listeners, you could leave, as some have suggested, create your own media company, and now you're making $500 million.
So despite spending over $1 billion on podcasting, Spotify has yet to see a return on investment. Many of the big names they signed are now gone. Harry and Meghan left after their podcast failed to take off. The Obamas decided to join Audible instead, and more than a dozen other popular shows were canceled.
There's not a lot of differentiation between one streaming service and another. And there maybe never will be, except for original content, which of course is extremely difficult to consistently produce at a high quality level.
Spotify is hoping that their podcast wing will turn a profit in the next couple of years, but there just isn't much wiggle room for failure, especially when most of their competitors, Apple Music, Amazon Music, Google Play, they're tied to these massive tech companies with multiple sources of revenue.
We just know that these companies have a lot of money. Apple famously has hundreds of billions of dollars typically on their balance sheet that they can sort of deploy into any business they see fit, and they can afford to make mistakes.
Underpinning all of this is the fact that Spotify pays a lot for its people. It more than doubled its workforce during the pandemic, going from 4,000 to 9,000 employees in just a few years. That made sense at the time.
In fact, Spotify's stock increased 70% from the beginning of January 2020 to the end of June 2020.
But that was when money was cheap. Interest rates hovered around zero, people were shopping from home, watching, listening, capital poured in, and the focus really was on growth rather than profits.
There's been no segment of the economy where investors have been more willing to front the bill for future growth. All the companies, whether it was Netflix, whether it was Peloton, if you had a business case built on massive double-digit growth rates, people were willing to put money in your account.
But now, interest rates have climbed to deal with inflation, and many investors want to see companies making profits, not just growing.
Eventually, you'll deplete your shareholder equity, and with each, when your balance sheet starts to become saggy, effectively you need to raise further capital, and the CEO pointed out that those costs right now are becoming prohibitively high.
Amazon, Meta, Netflix, they've all laid off thousands of workers in the last year, cutting back on massive hiring during the pandemic. And Spotify is no different. Pullback became essential. In January,
big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
And again in June.
Spotify planning to lay off 2% of its workforce, specifically from podcasts.
They're starting to, pay more attention to the return. They want to sort of have that scrappy, startup level culture where every dollar, is turned twice over before it's spent. And that's basically what investors are now calling for.
So maybe the question you have after all of this is, what does this mean for me? We already saw one price increase this year. We haven't heard about a second, but for a company struggling to turn a profit, it will be under constant pressure to find a way into the black.